But really happy to have you guys here, talk about what's going on in the market. And it's been some time since we last got together. We decided this time to change up the format just a little bit. We're going to have a bit of a roundtable with me and Jerrid. So you're going to see a more abbreviated slide deck today. And I'll tell you where you can get the full data set next week. But for those of you that love 40 pages of data, you'll get it all, just not today. So thanks so much. Want to introduce the team. We're now covering the 4 Western Washington counties. Want to thank all of our team members for being here. Want to welcome Henry Ruff. Where's Henry? All right, just joined the team and doing great. And Max is not here today, but Max is now covering Eastern Washington. So anything east of the mountains, talk to Max. Really excited to have a growing team and cover the whole state of Washington. So just a bit about what we've been up to. We've been really sticking to our business plan for 2022. We started the year with a forecast of getting 52 closed sales, a sale each week. We're at 45 year to date, and we've got 36 in the pipeline, so we expect about another 7 to 10 of those to close this year, but we're building up some momentum in next year. Our smallest sale of the year is a touch below 500,000, and largest is a touch over 100 million. So really covering a wide swath of the market. I'd say one of the big changes from our business plan is development sites. We were doing about 50-50, 78% of our sales year to date have been existing buildings, with the remaining 22% being development sites. So that's slowed down. My expectation is they'll kick up by about mid-year next year, but it's a bit of the sense of the market right now, and we'll touch on that in a bit. As far as our research format, we've changed all of it this year, so those of you who I haven't spoken with, we're now doing quarterly research reports, so every quarter we'll put out a new data set. That's going to cover sales, rent, and vacancy, and it's the 4 Western Washington counties, and then as of this year, we've added Eastern Washington for those of you that are interested in that market. As far as our analysis, we've also changed that because so much is happening in the market. So the data sets we have show 90-day quarter-over-quarter trends, year-over-year trends, and about 15 years of historical data. So lots of information in there. What we're attempting to do today is synthesize it for you, and we'll have the full data sets available soon. Finally, the special reports that we do each year, development report, our pipeline report, we just launched about a month ago in October. And our micro market study, which covers micro apartments, C2 apartments, and studios, that's coming out tomorrow. So look for that in your inbox. And then all of that's available on our website. So a lot of data and analytics we're putting out in the marketplace, and please take a look at it. Finally, agenda for today, we've got about half of the presentation is a regional overview of rent, vacancy, and sales. Jerrid and I are going to do an investment market roundtable, really getting down and dirty about what's happening in the investment sales market. We're going to spend a little bit of time on buyer and seller guidance, how we're guiding buyers and sellers in the current market, and then finally a Q&A section. So without further ado, talking about rent and vacancy, regional overview, I feel like there's been a lot of questions what's happening with rent vacancy through COVID. And it's great that we've got a full data set for 19, 20, 21, and almost 2022. And what that's allowed us to do is trend data because it's been so choppy throughout these last couple of years and really get a sense of what's going on in the marketplace, really sort of normalizing some of that choppiness. So overall, looking at a year ago to date is our data is formatted. So Q3 2021, we're basically back to full rents. So across the market, we were a touch under $1,900 a month across the 4 Western Washington counties. We're at what I call equilibrium with vacancy, so 95% occupied across the market. And what we've seen happen from that point to last quarter is we've pushed rents. Rents have gone up another 6.5%, but at the cost of occupancy. So it's cost us about 50 basis points. And so we've gotten so tight in the market that we can really get a sense of where market equilibrium is. And it's gone within 2%. So if you look at our most recent data set, rents are down across the region in the last 90 days, 2%, which is not that much. I'd say it's a statistical error in data within 2%, but we've gone up only about 10 basis points in vacancy. So what it's telling me is we're really understanding where the marketplace is right now, and I'd say we're at a good point of equilibrium. We're probably a little bit oversupplied with just the renter force right now, looking at where vacancy is. But keep in mind throughout all of these data sets, that this includes newly developed buildings that are in the pipeline, and because no one's really reporting on early stabilized buildings, this is my plug for Dupre and Scott. Patty, Mike, if you're out there, come back, please. We need you. We used to have 2 data sets for vacancy, and that included both new developments that were on the market, but also stabilized buildings. So we've got probably a point to a point and a half of noise in vacancy rates where they're elevated because of new developments coming to the marketplace. So keep that in mind, and also realize that noise is also relative to the markets that have a lot of new development. So we don't have as much of that noise in the suburban markets versus highly dense urban markets where we're delivering a lot of product. So keep that in mind. Moving on across the 4 counties, you look at King County, rents are a tick over 2,000, vacancies about 5.8. And what we're seeing here is we've largely recovered, and we're up about 10% from the lull of COVID across those markets. Now, some of the markets are only up 5%, some are up 20%. We'll talk about that in a moment. Looking at Snohomish County, they're getting close to $2,000 a month. Snohomish has gotten expensive, and I'd say a lot of what we've seen is during COVID a rush to the suburbs. No surprise to anyone. This market grew about 20% from 2019 to today. So nearly 7% year-over-year growth trended for the last 3 years. So it's been extremely strong. Pierce County, one thing I'd say about Pierce County is rents are still $200 a month below the other lowest priced county. So we still see opportunity in Pierce County, but we're starting to see that vacancy rate tick up. So we're starting to see equilibrium there, but there's still a lot of opportunity in Pierce. And looking at Kitsap, Kitsap has gotten expensive. I'd say 2 phenomenon, a lot more acquisition rehab and a lot more new construction. That market probably seen more in the last 36 months, 48 months, the last 10 years combined. So there is a bit of noise in the data with new development, but there is more rehab and it's gotten expensive, but also vacancy rates are probably more true vacancy rates. They're starting to tick up closer to 5%. So taking a little bit more individualized look, Puget Sound, we looked at overall data. This is just trended 15 years. You can see we've had a really good steady run of rent growth that's picked up. Across Puget Sound, we dropped off about $50, maybe 3% during COVID. So that sort of normalizes the suburban markets and the urban markets. And then we've ticked back up since that. So across the markets, we've had phenomenal rent growth since the lows in 2020. And then thumbs up for that, looking at vacancy rates. Now again, this data captures about 85,000 units that we're delivering this time period. So we see a lot of noise in the data set of vacancy. I'd say overall the vacancy rate was probably closer to 4.5% versus in this data set somewhere between 6.5% to 7%. So what we've seen, it's done well. We saw it spike a little bit during COVID, not nearly as much as some of the other markets, and it's gone down markedly. So it's really amazing the amount of recovery we've had across the Puget Sound region. This is one of the reasons why we think we're going to be the fastest market in the U.S. to pick up post whatever recession we're in or having. It's mostly psychological. I think when people realize the strength of this region, they're going to rush back in this market like they did in 2012 and 13. Moving to Seattle's urban neighborhoods. So if you can see up there, these are the 14 neighborhoods that we've delineated as Seattle's urban neighborhoods. These were the first neighborhoods where we saw a lot of new development. So we've seen a lot of price appreciation in these markets, but also we saw a lot of drop off in COVID. So COVID, we'd say smaller units that were self-managed, didn't have that much rent loss during COVID. Professionally managed buildings that were pushing rents may have been somewhere 15, even 20% off peak rents. But all in all, we lost about 10% of rent value during COVID in these urban neighborhoods. We then started to pick up, and then we picked up a little bit more this last year, but we had a bit of a false start in 2021. People thought everyone was going to return to work. We had a rush into these urban markets. Also, I think people got bored of the suburbs. They wanted to get back into urban markets. They wanted to go back to Salt and Straw and spend $8 on an ice cream cone, hang out with their friends, Capitol Hill was back again. But then it tapered off as 2022, we did not return to work. So overall, these urban neighborhoods were up 16% from the lull, but the lull was down 10%. So I think the important number with this is we gained about 6% rent growth in the last 3 years in the urban markets. 2% year over year is pretty anemic. I think there's a missed opportunity. I think there's probably another 10% of pent-up rent growth in the urban markets. It's not experienced. on top of whatever happens when we have urban growth. I think we're gonna see spikes in rents in the next 2 or 3 years up to 20% in the urban markets. But if you look at the data, most people look in the rearview mirror, it hasn't grown, it won't grow. I think the opposite is what's happening. If you look at vacancy rates across this market, have really low vacancy coming out of 2009, 10, 11. This spike that you see coming up, it's all new development. The average stabilized vacancy rate never really got above 5% until we got into COVID. In 2019, it really plummeted, and most of that's delivery of new office buildings. The office buildings delivered, people moved in, and completely filled the new buildings, and then all of a sudden we hit COVID. We had a huge spike. We were still delivering apartments, urban markets, I don't need to tell you anything about it, a little bit Mad Max a little bit, don't want to talk about it, a little bit rough. We're now in that recovery phase, and I really like what I'm seeing from occupancy, is unlike some other markets that are having greater spikes in occupancy, these urban markets are absorbing new supply, and they're staying relatively low to the overall market vacancy rate. So I think it's remained really strong, but it's embedded in the data. Moving on to East King. So we've separated our data. We used to cover some of the urban markets west of 405, along with Seattle. Our new data set separates that out. So this is all east of the lake, and we're looking at that as one market. And I'd say 11 out of 10 people I talk to want to be on the east side right now, maybe 12. And for really good reason. We've had phenomenal rent growth throughout this market cycle. A little bit of a lull during COVID. It dropped off just around 5%, maybe 5.5%, versus Seattle's urban markets dropped off double that, around 10%. And then it's picked up with massive velocity. So trough to peak, the east side's up 22%. But it only fell down about 5.5%. So overall, and that's a lot of numbers, we're up about 16.5% on the east side from 2019 to today. Whereas Seattle is only up truly 5.7%. And I don't think that trend's gonna hold tight considering where employment centers are and where young people wanna live. So we've actually experienced that massive rent growth on the east side. I think buyers are starting to underwrite the slowdown in new development over there, but it really is a treasury bill. And those are doing pretty well. East side's doing pretty well, but I think they're fully priced. And to add insult to injury of how quality the east side is over every other market, if you look at vacancy, really went down. Developers discovered where the east side is. I won't point any fingers, but some of them didn't want to go over there. They've gone over there, and now we've seen a rise in vacancy. We saw a bit of peak during COVID. We saw so much new development on the east side, but look at the response. It's been amazing how much new product the east side has absorbed and how high rents are. Bulk rents on the east side are almost $2,500 a month on average for the entire east side, compared to Seattle's urban markets that are already at $2,100. Now there's a bit of differential in average unit size, but unit sizes are starting to shrink on the east side. So it's been really, really strong. Moving to all the suburban markets, across these markets, we've lumped them together. We will have our new research report covering all this data coming out next Friday, and each one of these markets is broken out. So you can get as granular as you want. If you look at it, pretty anemic rent growth coming up to 2013, 14. We had to see the urban markets rise, push renters out. As soon as that started to happen, supreme rent growth, and then it picked up during COVID. And it really didn't drop off at all. And it grew in most suburban markets. If you look at what happened with vacancy, pushed down, this is more the response, it's less new development, this is mostly acquisition rehab. And what we're seeing is owners trying to titrate and figure out how much they can push rents, stay at a nominal vacancy rate. So we're starting to see rents rise, but also vacancy come up. If you look at the result of COVID, went back down. But what we're seeing in the last 2 quarters of data is vacancy starting to pick up. And I think the trend we're going to see during this recessionary period is the markets that have the most affluent renters are going to stay strong, and I think the suburbs are going to suffer a little bit more, which is the opposite we saw during COVID. So it's going to be a little bit different how these markets react. Moving on to sales, looking at Tri-County sales, this has been really choppy data over the last 3 years. So what you're looking at right now is going back to 2005 to year to date. What we're looking at sales volume, that's the blue, versus number of absolute building sales. So we had a really strong trend line coming up from the Great Recession. lots of building sales, lots of sales volume. It really spiked in 16. To me, that was sort of the point where the market stopped accelerating due to cap rate compression. What we really saw is rents pick up, and that was driving it until the last year or two where cap rates really compressed. We then get to 2019, excise tax. I never thought we'd hit another year like 16, but we proved it out. Never say never, I didn't think we'd see that again, and then we saw it again last year. The thing, it's a little bit different last year. A lot of this was driven with more institutional sales, so the actual number of absolute sales dropped a little bit, but tremendous sales volume last year with low interest rates and a lot of pent-up rent growth, and people wanted to seize that. And then year to date, this is where we are. It's been fairly anemic with what's happened in the last 90 days. We had a great start to the year. None of you need to know what happened. You all know what happened. We don't need a great detail, but we've seen a huge slowdown. We'll talk about on a percentage basis how much we saw that slow. Looking to, this is all the sort of the ride of the number of sales moving through. All these dips, a lot of it is just the institutions in and out of the market. But overall, we're pretty far down, and I expect Q4, which is normally a very large quarter in sales, not to be that impressive. We're gonna have some sales, but I expect it's gonna be nothing like we've seen before. Now, moving over to historic sales value. So what we look at on one side is price per square foot. We're using that increasingly just because of differential in unit sizes. We're seeing developers build buildings anywhere from 300 square feet up to 750 square feet. So price per square foot seems to be a better normalized metric for values, sort of same store sales comparing. The other is cap rate. Been choppy. A lot of this is just differences in how much rent growth we were getting. Overall cap rates, as you can see, were declining, but really rent growth was what was sort of the arbiter of price per square foot. We saw it drop during COVID, no surprise there. It picked up, and then it kind of normalized year over year. What we've seen with cap rates completely compress. We saw a little pickup in 2017 and 18. The market slowed down because of rent growth, and then we saw it come up a little bit during COVID, and then it dropped back down again. What I'm going to talk about in a moment is just, I think this data set is just too premature to tell you what's happening today, and that's why Jerrid and I are going to focus on what's happening in the market right now, because I don't think the data is really demonstrating where the marketplace is today. Taking a look at cap rates, so what we're looking at here is the red bar this is county by county. So we're looking at King County across all the way to Kitsap County. And just looking at overall, you can see from a cap rate perspective, King County urban markets have been about a 4.5 cap market, maybe touching below 4 cap in the urban centers, maybe mid 4s in some of the suburbs in King County, but normalized at about a 4.5 cap. And the suburban market's been anywhere from a 5 to a 6.5. You look at what happened in 2021, they all plummeted. I don't think anyone predicted this, especially during 2020, a COVID year. People thought 2021 was a recovery year. I don't think anyone realized how much compression we'd see in cap rates. We've talked about that before, so I don't want to take too much time going into it. But really, we had a huge compression. What I'd like to look at now is 2021 versus 2022. And by county, King County is the only county where we've actually seen cap rate expansion. Now, it's 10 basis points. Anyone who thinks it's still a 4 cap market probably is a little bit off of where the market is today, but it's the only market that did not compress year over year. So we've already started to see a little bit of expansion in cap rates. I think we're wide of this probably by another 50 basis points today. But if you look at all the suburban markets, these are still holding strong at sub 5 caps, and all of them have compressed, which if you look at the historical data I just presented, they're all 5 to 6.5 cap rates. So massive amount of cap rate compression in the suburbs. And the question is, will that hold when debt's getting priced at 5.5 to 6, maybe 6 plus right now? So a lot of unreported data so far on the sales market that we're going to get into and talk about right now. Jerrid, you want to come up?
Testing. Just want to say a quick thank you to actually Dylan some of the faces here have been coming to this investor forum for 8 years now, and I think Dylan's done a fantastic job. Spends a lot of time pulling these slides and this data together to give us all these insights. So I don't know if anyone's properly thanked him, but quick round of applause for doing so.
It's embarrassing to say that I like it. So, for all of you, I haven't taken to dinner often enough. Here you go. Here's your data sets. Thank you very much, Jerrid, and really to the whole team. I will. Where's Brandon? Winslow. Every single sale, I think we've had 266 sales year to date. They call the buyer, they call the seller, they call the broker, and they harangue them to figure out where cap rates are. I always complain or argue that cap rates are for the buyers, the sellers, the brokers, and the real, and the truth somewhere in the middle. But it's really hard to get good data on actual cap rates, and that's what Mike and Patty did a really good job of normalizing that data. So thanks to the entire team for helping put this together. So the first thing we're going to get into is just look at the time it takes for an apartment sale to actually close. So about 3.5 months in a healthy market, and then you can see these spikes that happen during COVID, just taking longer to get deals done. And you look at what happens in this last 12 to 18 month period, where it dropped down markedly, and this is where we are today, is where we're picking up. So the data sets that we've put together about listings we've had, just under 40 listings that we took to market between Q1 and Q3. Jerrid, what have you seen as we've traversed these last many months of how long it's taking to move a sale through, and what's happening to the ones that don't get moved through?
You know, what's interesting about the dip, one of the largest dips below the red line there and the amount of time it took, that was probably the first time I saw buyers and sellers cross the aisle and want to put deals together. They all knew interest rates were going up. Seller said, I want it sold. Buyer said, I want to buy it with a 3% interest rate. So they were working hand in hand. And since then, I wouldn't say it was a shock, but in that first interest rate bump in May is when we really saw things drop off and the amount of time it took to put a deal together, get it over the finish line. And I think that had to do with the dislocation between pricing expectations of the seller and the buyer. And then you can see how sharply they've risen. And I think and we'll look at this a few different ways, but one thing's a little misleading when you look at data is that sharp rise in the amount of time. I think that has to do a lot with some sales that just have been on the market for a very long time, right? That we know the seller doesn't want to sell at the price the market's at. There's no buyer to come up. So those are artificially handicapping those. I'd say the sales we brought out, and you'll see this data in a little bit, in the last couple of months, we're able to right size values better and then moving quicker.
I'd say one of the challenges with the data sets we get, this is CoStar data, we'll look at another data set in a moment, is this probably covers about half of the sales. They do a decent job, but they don't capture all the sales, but I think it's fairly representative of the market. And a lot of it is just lack of urgency. We saw this huge amount of urgency in 2019 due to the excise tax, a lot of urgency in 2021. It dropped off in 2020. I think where we're going is I think we're gonna see this spike again, probably higher than we saw the last spike. Just part of it's seasonality. I just don't think people want to get a lot done before now and the holidays. And I think people want to wait out the first quarter of the year to see what Jerome Powell does, what other people are doing. So we're on the front lines of these, and it's been really telling just to see what languages. And we're going to talk to Jerrid's point a little bit about pricing, because this isn't a lack of capital. I think what we saw in 2020 was a lack of capital. I think what we're seeing here is true dislocation and interest in getting a deal done due to uncertainty versus just the ability to capitalize a deal. Now, taking a look at absorption rates, so this data, this is actual MLS data, and the reason we pulled this is they capture every sale. And so this is data sets, it goes down to 3 units up to about 20 units, so about half this data is 5 unit to 20 plus unit transaction. So not what everyone in this room does, but it's fairly demonstrative of what we're seeing in the capital markets. And you see about 30% of it goes pending. And so it's sort of in line with home sales. You generally want, with home sales, about 6 months of inventory. We've had about 3 months of inventory. At 30% sales, you're moving through your inventory in about 3 months. And so that's a healthy market. What we saw as interest rates were about to adjust, people, buyers and sellers were really seeing what was happening with interest rates, but also rents. I mean, rents were going crazy from about April 2021 through, it was last year was the first year I saw nearly zero seasonality and actual rent growth through the winter months. And so buyers were pushing through that in Q1, and as a result, twice the inventory was selling. So that's a huge differential when twice the inventory sells, and then we're in this dip right now. So Jerrid, back to you. I mean, this dip, what are you seeing in this dip as far as what's actually getting sold, what's going pending versus what's taking the market?
Yeah, I felt like the initial cause of the dip was the drastic increase in the 10-year treasury and therefore interest rates. I also felt like in that period where we were doing so many sales and that peak, buyers hadn't looked at many properties, made many offers during the let's say the pandemic year, and therefore they were, I don't want to swear, they were working very hard and making a lot of offers. So it partially is like an economic change, and partially I talk to a lot of you on a frequent basis. People took the summer off. So I think it's maybe over accentuating how maybe impactful that interest rate was. I feel like the rise was, one, people coming back, their kids going back to school, but two, we had such phenomenal rent growth this summer, it actually helped stitch some deals together that were on the sidelines. So that's something that's interesting just overall.
What I saw to that last point was rent growth, is it seemed like we were watching interest rates rise and we were watching rent rise. Rent wasn't going up as fast, but it was inspiring buyers to overcome creeping interest rates and continue to buy into a really healthy market. We hit the summertime, I think people took time off, but I think the expectation was we were going to see rents continue to rise, but then what we started seeing creep into the psyche of buyers, as well as their capital partners, whether it's lenders or LPs, was the threat of recession. So the biggest change in underwriting from the summer till now is rent growth projections. Now, we were seeing terminal cap rates go up, but as we're talking to people, we're really seeing them cap rent growth projections. We pull a lot of data from CoStar. They're a great partner in providing a lot of data, so I don't want to deride them in any respect, but sometimes they'll make changes without necessarily reporting on the changes. So I went and I looked at rent growth assumptions, because a client said, yeah, they really downgraded rent growth. They took this like sharp upward rent growth after 2020, and they just normalized it to 2% till like the year like 3000. Like it just goes out forever at 2%. Like things, the world's never gonna be above 2% rent growth. It did not look that way 90 days ago. It was like this really healthy spike in rent growth coming out of COVID, coming out of the summertime, jobs were coming to the Pacific Northwest. So I don't know what happened with that, but I think what's happened is there's been enough chatter about, first it was Russia and it was recession. Now it's just overall, the government's going to drive the economy into the ground, and as a result, there's not going to be any rent growth. I will cuss. I think that's total bullshit. I just don't think that's going to happen. I've never seen anyone underwrite a recession. Just when they're in one, they flatten everything. When they're out of it, they grow everything. Those are like the only two underwriting strategies. So I think those of you who can look at like 70 years of data and underwrite an upturn during a downturn will win. Just do that. Just look at 70 years of data, normalize the graphs of the upturn and apply them before it happens. And if, is there anyone, I don't think there's anyone in here where their underwriting period is less than 3 years. It's probably 5 to 7 years. But we're making decisions based on what's gonna happen in the next 6 months or what CoStar thinks is gonna happen in 2 years. So, yeah, I get a little passionate about that, but I think we're in this psychological recession. And I think people, in the graph displays, people are not hungry to get something done because they don't know what's gonna happen next.
One more thing to add just for this specific data set. If you look September of this year, September of last year, median asking prices are up 17%. I think it's worth noting. This doesn't show you that there's been some undulation in asking prices, it's just the number of sales that are coming together. And so somewhere in between that's probably where they actually pencil. And so I think that's worth noting that there's been quite a bit of appreciation year over year, or maybe expectation of growing quite a bit year over year, trying to capture the prices that will win the peak. So I just think that's interesting.
So when we were planning this and I was asking Jerrid what's topical and I wanted to pull a bunch of other people's data, he said, well, why don't we just use ours? And then I got scared that we had good data sets. So we collected the data, and this is sort of the other side of that. This is months of inventory. Before I get to that next story. So months of inventory, about 3 months of inventory like we talked about. A massive spike in inventory for 2 reasons. Owners saw pricing. They wanted to get on the market right away. I had people calling me in June saying, I want to get ahead of this. And I was like, where have you been? You're behind it if you're listing in June. But people wanted to come out right away to get ahead of this, right when the market stalls. Like this perfect storm of people coming to the market with new listings and then the buyers evacuating. Jerrid, do you want to talk a little bit about what was happening leading up to this summer and what we experienced during the summer?
For sales is exactly what Dylan was saying, because there's, as you saw, 3.5 months to get a sale closed. Most people were seeing those retrospectively. Oh wow, I didn't know I could sell my building for that much. Go do that. Well, I'm a broker, I'm not gonna say no, right? We gotta take a run at it, but as you'll see in the next few slides, maybe you should have said no on a few of those.
So let's check out some of the no's. So here's back to the data set I was nervous about. So I had a long talk with myself, which just means I drank a glass of whiskey as I looked at the data, and said, don't monkey F with it, just hit average function in Excel and see what it spits out. So I think there's some anomalies in this data to protect the innocent or the guilty, but this is just pure data from 38 sales. So this is Q1, this is what we brought out of the market in Q1 and what eventually happened. So confidentiality agreements, like this is our metric of like how many interest buyers are there in the marketplace. Who's gonna click, sign a CA? Now I'll say because of the rise in sales coming from 2021, there's a disproportionate number of more institutional sales. So I don't know if that number is above 30 million or 50 million, but these are not $5 million sales. So we had more of these in Q1 than Q2 and Q3. So we averaged 110 CAs, we averaged 15 tours, and we got 5.7 offers. So whoever offered 0.7, I'm going to single you out. It's a horrible offer. So this is what the data shows. Now we move into Q2, and Jerry, do you want to talk a little bit about what we were splashing water on our face in Q2 and seeing?
Yeah, as we said, we did a lot of work and didn't get a lot of pay. So 2 things, as Dylan mentioned, when you have a more what we'll call institutional sales, so let's say 30 million and up, we're going to get more confidentiality agreements signed, and those are quick movers ready at the beginning of the year. We saw more mid-market, where I've focused, kind of 5 to 30 million come to market middle of the year, and so inevitably those will be less confidentiality agreements. So that does change it a little bit. Still had a decent amount of tours, 2/3. It was really seeing the offers almost cut in half that showed us there was less buyer demand at those price points.
So urgency dropped off, and really, you can almost just draw your finger like this line that it was like a 3.5 cap market through February into March, and you just saw interest rates, and it went to a 4 cap market in the spring, and like summer it was like 4.5 cap market, and then now I didn't bring my magic 8 ball, but it's somewhere between 4.5 and 5, depending on what the asset is. And I'm still talking new construction core, if you can find a buyer. And part of that is what does occupancy look like, what rental rates look like, how much loss to lease. But it went up. And along with that, what we saw though is more price discovery, as we saw more transactions get done. So we ticked back up with confidentiality agreements. I'd say that's a little bit misleading because still more institutional sales, just given the marketplace and where capital was going by Q3. So it's actually, that number would probably be higher on a relative basis. So we're getting more buyer engagement in Q3. We're getting a lot more tours, so people sort of got off their humps, they got out, they toured properties, and the actual number of offers ticked up pretty markedly. So people were discovering the market again after that summer lull. So moving on from that, the question is what happens with those offers? So we're getting offers, what does that mean? So this is a graph. I mean, this is CoStar data. It's not all reported, but when you throw it all in sort of a bucket and mix it up, it's going to give you some semblance of normalized accuracy. What you're seeing from 2017 and 19 is sort of a hunting and pecking of guidance going 4% below, sales 4% above guidance, 4% below. And as you can imagine, this is just tracking with what the market's doing. We're guiding to pricing. If the market's really strong, we're gonna get sales prices higher than guidance, an accelerating market. And this happens in all markets. You're hunting and trying to figure out where that pricing guidance is. You sell some buildings, they go high, so inevitably your client wants you to push guidance higher, so you push it higher and the sales go a little bit lower. And then you get to that zero mean line, which makes sense over a couple of years about where it should be priced. You can see what happened in 2019. It plummeted, in 2020 with COVID, and these sales were happening, came to market in Q1. COVID really hit this market about March 15th, I know, because we just launched a listing, and I thought my computer was broken because no one responded. It's like, what's happening? It's like, oh wait, there's a pandemic. So, and then the last, since then, we see this choppiness into this sort of below the 0% line of deals just aren't hitting guidance. And Jerrid, what do you surmise from where we are right now?
When I think about guidance, I think about my clients. Love you all dearly, but I get to have them call me and say, saw that great sale comp, can you just do that or maybe a little less? Right? So we're always being pushed, and as we should be, and we're trying to push the market to achieve a higher price. I think that's baked in here, that we're constantly pushing ourselves and pushing the market to achieve a higher price. When all things are equal, sometimes we can do so. When they're in our favor, interest rates are going down, we might beat it, and when they're going up, we might come in a little short. And so that's been the feeling lately, and this kind of 2 to 4% discount. What's in front of us and what this data doesn't report is what's happening right now. And if I look back to 6 months ago, pricing depending on the location, the quality of the asset, and really importantly, what everyone was forgiven for some reason, actual cash flow, that'll have a huge impact on price. So at one point in time, I could just take your 2-cap deal that you operated like crap through the pandemic and sell it for that 2-cap, because someone else is going to buy it at the 2 with 3% debt. And the reason why, they had a huge spread when they stabilized to a 5-cap, right? Over their debt, they had 200 basis points. Now buyers are accepting lower returns because they want to buy properties, but it's really a question, is the seller willing to expect a lower price?
Another aspect that's not baked in here is just where absolute pricing is, and the differential in where are assets valued today, mark to market, where they were valued back in 2019 before the pandemic, and in 2021, which I'd argue was peak pricing in the market. And so guidance it's changing as the market's changing, as we're guiding at different levels based upon the feedback we're getting, the offers we're getting. And what this doesn't really show is where is absolute pricing. And I think what we saw in the marketplace is coming into the run-up in 2021, like I said, we had this massive amount of rent growth. We also had depressed rent rolls. So we had forecasted and real rent growth, and we had a ton of loss to lease with these COVID rent rolls. So these 2.5-cap deals are getting done, these 3.5-cap deals are getting done. So the marketplace says, oh, the market is a 3.5-cap market. Well, it's a 4.5 stabilized market. So you repair those rent rolls, you still want a 3.5 cap, there's no more loss to lease together. But there's massive rent growth. So there's sort of this mind game going on with buyers trying to convince themselves to participate in the market and capture this rent growth. So what does that mean? Well, that means in sort of the peak of the market that was probably Q4 2021, early Q1 2022, asset values were probably 10% higher than they should have been, just on pure fundamentals. They're probably 10% higher. And so as we're guiding and guiding down because interest rates are going up and loss to lease is going down and actual rent growth is going down, we're having sellers say you should meet the market. Well, I'm 10% lower, and what we're hearing is buyers saying, well, wait, you're marking to when interest rates were in the 3s. I'm now 10% lower than that. So I think the punchline where we are today is, I think we're probably somewhere on the order of magnitude 15 to 20% off peak prices. And I think the market overall, sellers have accepted up to 10%, but that last 5 to 10%, they're not there, and there's a dislocation. So the report that we'll put out next Friday breaks down sales in every market and price and all the good stuff you love to look at. I just took a look at it before this, and I'm just looking at sales volume. You take a county like Snohomish County, and I'd say the last 5 years, we would see 90 to 100 sales in the year in Snohomish County. Year to date, there's 43. So we still have a big Q4 to happen. I don't think there's a big Q4. So maybe another 10 sales happen. Suburban market, strong market, but sales could be off 50%. You look at South King, generally have 60 to 75 sales a year there. I think we're at 46 sales year to date. So we could be off by 40%. Look at the east side, one of the strongest markets, normalized the last 5 years, 25 to 35 sales a year. It's been really hot the last couple of years. I think year to date, there are 12 sales on the east side. So we don't have the data, we don't have the sales. The market's completely fractured right now. To me, the old adage, good deals are done in bad times. I mean, now's the time to get deals done if you can get the confidence and get price discovery. You're seeing there is data, deals are getting done. The question is, at that price. So we'll move on. This was the hard sip of whiskey of what actually happened with our closing ratio and our actual pricing. So Jerrid, how was Q1 for you?
Really good.
We practiced this.
No, it was phenomenal. We saw, it was interesting, the end of 2021, right, a lot of buyers just showed up. During the pandemic, they just weren't there. And so we had people knocking down our door to buy apartment deals, and we had them priced well, and we got multiple bids, and we bid up higher above what the asking price was then. So then, as I mentioned earlier, next seller says, oh, let's beat that, and let's beat that, let's beat that, and we kept doing it. So within 2%, I feel we were still knocking out of the park, and having that closing ratio, I'd say as a team, looking historically, we do beat the market. The market's closer to 50% closing ratio, and we've been somewhere between 70 to 80.
It's gratuitous self-plug.
Yes, hire us.
Remember that.
So just keep that in mind as we go to the next one.
Yeah. So moving into Q2, no big surprise. We're chasing the market. We're attempting to adjust guidance, and I remember really clearly doing a valuation for a client, and we did a pitch over Zoom, and the first thing I said is, we're not going to look at sales comps. He said, I want to look at sales comps, and I said, you're not going to be happy, because every sales comp is better than you're going to do, because that was all trading off of cheap debt. And we're chasing that market, trying to figure out where pricing is, and we did discover pricing, we just didn't find the buyers. I mean, this is where the market got really fractured. You see some of the spikes in the other graphs we showed, is we just weren't meeting a market because there is still too much price discovery to have. And our pricing was wrong. You look at it either way. If you don't find a buyer, you're priced wrong. Now, part of that's the impact of the market, and I can blame clients and Jerome Powell all day long, but the end of the day is that was the biggest fracture point in the marketplace.
We were saying around the office that all work and no pay makes Dylan a dull boy.
I don't golf. Well, I golf. People have seen me golf. It's not pretty. And I can't ski in the summer unless I go to South America, and my wife's wonderful, but not that wonderful right now with a toddler. So yeah, if I can't look at data and sell buildings, I get pretty dull. So we're looking towards, I was just like, let's hold on to Q3. Q3 is really going to turn around. Well, sort of. So again, we're chasing the market with pricing. I should have overlaid the 10-year on this. It'd make a little bit more sense if we overlaid the 10-year. It was still had really good rent growth. This is like the biggest anomaly this summer is people would ask how the market is. I said, do you want to talk about the operational market or the investment sales market? Because the operational market's fantastic. Vacancy is going down, rent's going up, we've got a backlog of renters, everything's great, we're absorbing new buildings. But the investment sales market, we're seeing investment capital leave the market, we're seeing interest rates go up. So the pricing continued to drop, and I think part of that is we weren't adjusting pricing. So I think really we were getting some price discovery. This is the number I wanted to change to derive myself, because I think we were getting a little bit closer to 3 to 5%. But I think part of this is we had sales that were lingering from earlier the year. But the asterisk, the 42%, these haven't closed yet, but these are deals that are gone pending. So you can see this is now doubled from where we were in the summer. Is we're not only finding buyers, but we're getting them under contract and we're moving sales through.
interesting anecdote from the prior data set we were looking at. If you looked at September sales, I guess it was Q3 sales from 2022 and Q3 2021, when things felt like they were really rising, you'd assume that that time in 2021, the building sale values were much higher. They're actually lower, right? So these sales that are occurring, even though a client, a seller may feel that we're 8% below, we're actually beating where we were a year ago, and the year before that, everyone was concerned the market might never come back. So it is something interesting psychologically to think about, that I think the pricing is fair. Buyers are having to actually accept a lower return than they would have this time last year to purchase a transaction. So is it a good market, is it a bad market? It can be argued either way, but I mean, values are steady where they were a year ago. Maybe you missed that peak, but catching a peak's nearly impossible. People that chase that I've seen lose more than win.
So moving on from that, we sat down and asked ourselves, what's really happening in the market, and if we could sit down and talk to building owners and buyers, what would we say to them right now? And I just looked at the data to update our website. So year to date, we've made just under 22,000 sales calls. If we're doing it right, we're calling building owners. So I think we're talking to a lot of you, hopefully. I won't do a show of hands, but hopefully you're getting your phone rung and we're calling you and asking how things are going. So we've got a lot of information. We've taken a bit under 60 buildings to market during the year. And from this, here's our guidance, what we're seeing. What we're telling owners is, if you've got debt maturing in the next 2 years, you should be thinking about it now. You should be talking about how you want to position your building now, because getting a sale done, getting a refi done is harder. They're looking at a lot more trailing data. You're not forgiven for a lot of ills. Jerry, you want to cover this next one?
Yeah, this one's been interesting. We haven't seen many debt assumptions in my whole career, nearly a decade, nor have we seen much seller financing. We're starting to see that crop up a bit. So if someone got some great financing when it was really affordable and it's a decent loan to value, it's making it a more attractive property. So it's actually creating more competition. I'm not saying it's pushing values above where it may have been 3-6 months ago, but they're holding more steady. So that one's been an interesting one to watch.
I'll say on that this is empirical from transactions we're working on. We've had some people come to us with assumable debt, and they think that the attractiveness of it will increase over time as interest rates continue to go up. The challenge is with just the way terms work with most commercial loans, you're starting to lose term on the backside. And so I think by holding out too long this precious assignable loan, if you're losing term on the back end, that becomes a challenge as well. So I think certain owners really want to get rewarded because they have this golden goose. What we've been advising clients is, if you have a buyer and it's a good buyer, it's within 3% of strike price, you should stick with that. You dance with that partner, because we're just not seeing a deep pool. And I think people are back in 2007, 8 and 9, people are holding up appraisals from 2007 saying this is what it used to be worth. That's just not the case anymore in the market. So I would market to where your returns are and to where your basis is, not to where it was in 2021. Next thing is, if your building's not operating well right now, and judging by how many people we know in the room, it's probably not the case, but it's not the market, it's you. It should be operating pretty well. Now, there's some new construction where there's a lot of deliveries and absorptions taking some time, but for sellers, it's time to take a hard look at how you're operating your building, because the market is not going to forgive you like it once did. Back to Jerrid's point, we used to be able to go and take a lot of loss to lease and sell that loss to lease to the next buyer. That's really not the case. And so it takes a while to improve those operations, but you really should be looking at your building operationally and wondering how to optimize, because not only are the sellers looking at it differently, there's a couple lenders here, I saw you. I know you guys might be a little bit more jaded in how you look at operations than some of the buyers out there. Your lenders are really going to take a hard look at trailing operations and wondering how you're going to do better. And finally, Jerrid mentioned this before, cash flow. You want to talk a little bit about what we're seeing?
Yeah, this is not even just for a seller, but for an owner. A lot of our clients plan to hold long term. We recommend it. But focusing on the cash flow is a great way to spend your time right now. You can have a much better impact there than trying to change interest rates or purchase prices, right? So digging in deep is really important. And just on the overall selling, I heard this yesterday from a mentor, so I figured I'd share it. He said, is the pain from not selling today and finding your building value to drop 20% over the next 12 months more impactful to you, or would be selling today and finding the building's value rose 20% in the next 12 months more impactful? That's a big consideration when making a selling decision. It's not all about the numbers. There's definitely an emotional side to it. And I don't want to ask anyone to raise hands, but I think if I polled the audience who thought values were going up 20% or down 20%, we wouldn't see me too for the up. So if you're considering selling, it's still, I think, a fine time. We're getting multiple offers on all the deals.
Moving on to the buyer side, I can't give this guidance enough. Offer, offer, offer. I'll tell you from what we're seeing is if a deal falls out of contract, and as much as we hate it, they do, I'm not going back to my list of 200 or 300 people we may have called and 110 CAs. I'm going back to people that offer. And on multiple occasions, we've sold buildings lower than our guidance. Yep, we love to be perfect, and sometimes we've sold them less from the first contract they were under, and sometimes less than the second. So if we have an offer from you, two things are gonna happen, well, three are gonna happen. One, we love having offers. It validates the market, so it's helpful us to do our job, and it just helps the marketplace to know where assets are priced. Two, it puts you in pole position to pick up the asset if someone drops out and we have a client, often we do, they say, let's go back to the other group. If we say, well, this other said they're interested, call us back if it drops out, and oftentimes our client said, well, they must not be that interested if they're not writing an offer. So we can't control their emotions on that side. So just knowing that offer in hand is helpful. And three, when you want to get an update on what's going on with the deal, we're going to share a lot more information if we were sitting on an offer from you to keep you close to it. So I really think that if you are in this market waiting 3 months or 6 months to see what happens, I don't think it's beneficial for you to not know what's going on in the marketplace. I always say if you do the homework, turn it in. I've never been offended by an offer, and I've had some crazy ones. So offer, offer, offer. You want to talk a little about urban markets, Jerrid?
Yeah, I might jump through these last three quickly. I know we're just at time. I want to leave some time for Q&A. If you want to hit those last three.
Yep.
So interestingly enough, a lot of people went out to the suburbs. We're fortunate enough to work with so many different clients. Some of the privately held, self-made billionaires up and down the West Coast, they've been suburb far before the pandemic and everyone moved there. Guess what they're offering now? For the first time since I've been a broker, they're offering in the core again. So just following the guys in the middle, guys and gals that have made a lot of money, they're starting to look at the core. Picking a price per square foot or per unit that makes sense, right? You're well below replacement costs. I would have bought that several years ago. You're really just betting on the overall market. Do you think Seattle will outperform other markets throughout the country? If so, it'll hit a point where it just makes sense to buy, even if maybe the cash flow or some of the numbers in the short term don't really add up. And lastly, buy all the maybes. I heard that from a mentor. I was actually under contract on a property in Spokane. I was really excited about it. Had that maybe and walked away from it during the pandemic, and man, we should have bought that deal. So buy all the maybes. Open it up for some Q&A.
Everyone knows what's going on out there? Yeah, Dave.
I've got one. There's a lot of product that's coming online now. It's not stabilized, right? They're leasing up. What are those guys going to do? And do you see those as buying opportunities in the next 12 to 24 months?
It's a great question. Luckily, the market has given us a lot of turbulence the last 5 years. So these strategies emerge that I'm going to buy a pre-sale, I'm going to buy a distressed building. I will say this is probably one of the times where that's going to happen before the capital market saved everybody. If there was a developer that was a bit underwater, had an expiring construction loan, they wouldn't extend it, someone would come in, a debt fund, a mezz lender. We're seeing less of that happen. What I'll say is a lot of the developers out there are experienced and they're well capitalized, but not all of them. So I think the big question is how much does rent slow down? Like how much does demand slow down? But I finally think because we have so much dislocation, there may be some opportunities on that side. but I have a feeling if you want a 20% discount, you're probably gonna get a 10% discount. And I'll say an adage I created is underwrite to the next market peak, not the last market peak. So if peak pricing was 300 a unit last cycle and it's 450 a unit now, and you get a deal at 400, and you're saying, gosh, it's only down 10%. Well, if the next peak is 550 or 6, you get a pretty good deal. But people, they just don't look at that. If you look at the trend line over the last 50 or 60 years, if you don't believe in that market, you shouldn't be buying it anyway. You don't believe it's going to appreciate. So I think the discounts aren't going to be where you want them, but I think there could be opportunities, but they're not going to be at that 20% discount. Yeah.
For Seattle in particular, are you hearing anything about potential rent control? Any
No.
buyers?
I prepared for this question.
More slides.
I get it often. Looking broadly, so across the country, I'm sure many markets have tried and failed. It seems like for the most part,
Never
with rent
works.
control, never works, right? What doesn't it work for? It doesn't work for the actual renter, right? But it's actually done really well for the investor in the long term. And so the two most well-known markets for rent control would be New York City and San Francisco, two of the most expensive markets to rent in and two of the most expensive markets to buy in. So are we in support of rent control? No, but it's somewhat happened because of COVID and these new rules that keep getting layered on. And I think what I'm noticing is the early sign of why this is going to increase building values much more over time, so it's a longer term play, is we look at the development pipeline. About 40% of what was in the pipeline was breaking ground for several years, over a year. It's at 16% right now. So developers are pulling back, projects aren't penciling, the rent control is a big risk, and we're gonna have less supply, more people will keep moving here, Amazon will keep hiring, and the values will go up. So is it good in the short term? No. Is it good for the renter? No. I don't agree with the policy, but as an owner, it's actually a long-term benefit if you look historically and look across the country.
Yes.
So in 2023, 2024, you're going to have a lot of suburban TOD stations coming online. How does that shape up with your comment about urban, people moving back core urban in terms of those suburban stations? Does those still have value or not so much?
Yeah, I really try to look in the long view, and we're probably the only country in the world that just completely built out our suburbs and then did not create the infrastructure for people to get from the suburbs to the cities. I don't think everyone wants to live in the cities, but I think that cities are job centers. I don't think that's going to change. I think this work from home, I'm a work from home denier. I don't think it's going to last. I think 3 years from now, we're going to see 95% full office buildings and kick ourselves. Why didn't we see that? Human nature takes a long time to change. So to answer it directly, I think they're important parts of our ecosystem. And I think a lot of people want to live in the suburbs and they want to get into the city. So I love TOD. I would prefer TOD where there's some there already, or they're creating some there where there's an urban center, versus just a spot just sort of picked because geographically or land use wise or for whatever reason it made sense. So I tend to think that those stations will do better where they're plopped down in the middle. And you look at areas like Columbia City, there used to be a rail line. So if you look at where old rail lines used to be and you overlay new rail lines, it's probably a good place to be, because 100 years ago they had to be really efficient. So they picked the right spot for rail lines. They're just putting them back. It's happening all over Denver, all over Salt Lake City, all over Seattle. So I would pick I'd be choosy about the TOD sites, but I think it's an important part of our infrastructure, and MARTA's done pretty well. We could have had it 40 years ago, we turned it down, so now it's just much more expensive, but I think it's an important part of the future. So I think they're going to do well. I think the ones certain will outperform others based upon what I call the importance of Saturday morning. When you wake up Saturday morning, where are you? What does that look like? What does that feel like? And I'd use that as a lens to where you want to be vis-a-vis TOD. The other part is capital loves TOD. They just do. And as every developer in here with their salt knows, if you have capital, you're going to build.
TOD is within a quarter mile, not a mile.
Well, we're long. I really want to thank everyone for joining.